Want my latest market insights? My latest report, Recession Risk Just Got Pulled Forward, is now available. Scan this QR code or click on the link in the description. Welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht over there on the West Coast, Boston to Toronto. We got the whole place covered. We are coming together to talk macro sector rotation themes, stocks of interest, options, both for the market, also how to play, durable themes that are working, as well as some chase duration, swing duration setups. Congratulations, by the way, on your NBIS. Hans in particular, he nailed it, but he used leaps, which is so smart. So people who were actually using the September monthly had the same returns, really a few 100% as you did with your leap. So well chosen. You had time. Anyway, let's go about talking about a rundown. We've got Oracle that hit the cover off the ball, not when it came to the actual earnings. All right. They actually missed. Earnings were down 2%. Software revenue was down 12%. They had free cash flow negative, almost negative $6 billion. But that didn't matter because Ellison came out and talked about how sweet the future looks with some amazing RPO numbers, which is basically just massage the growth expectations. He became the richest man, catapulted, I think, $100 billion worth in net wealth in one day, or I should say one evening, at 81, not bad. And he is 81, so basically
81. Wow.
Hope he doesn't die anytime soon. He's trying to extend his life through all kinds of money that is made. So we have a situation where Oracle is that sentiment drive for AI that helped the entire landscape, from the semis to the data centers to the miners. I'm talking the Bitcoin miners and everything that uses GPUs. So Nvidia got back above that 173, very key level. Remember, we talked about that 172 that pulled back past few weeks in Nvidia earnings. Perfect. And I said it's bullish again once it gets back above 173, which of course Oracle helped. And that was also right before our PPI data that came out this morning, which I think is being incorrectly interpreted as a deflation, which is not. It is falling demand, but it did help the rate cut odds. In other words, the market is not pricing in anything that's bad. Bad data is good. So falling PPI is basically translated into the Fed will cut rates sooner and for longer, and therefore it's more monetary easing that the bulls love. So they gapped it up 65.50 and thereabouts, and then basically softened on some profit taking. Oracle did too, after again a very outsized move. And when I say outsized, I mean I have never ever seen Oracle as extended since the 2000s. So in the 2000s, it's mean on a monthly. You know me, I'm a trend trader, right? So I like particular moves that are durable and also definable. And during the extravaganza of the 2000s, it actually had like a 50% extended from its mean. Well, it hit 36% today and after hours, and that's outsized. In other words, even in its most bullish days in the past, like 1992, I think it had a 25%. Anyway, the point is, it is very, very bullish. This whole AI sentiment, how long it can maintain is another question. If you really kind of look at it, these are promises, not necessarily fulfilled. And then, of course, PPI in all its glory. We're going to have CPI tomorrow, but this is all kind of part of that discussion we've been having for a few weeks, where we've got this choppy market into FOMC, which is on the 17th, and then options expiration on the 19th. That I think is going to be much more impactful after we get through options for not just the monthly, but also the quarterly at the end of September, and we start hitting up against Vegas odds for a government shutdown. In the meantime, the market is not pricing in anything bad. That's why it's bullish. Hans, take it away.
Oracle, they were expecting an $18.65 move. So that means when you look at the straddle, which is the at the money call and the at the money put, you add them up together for the most near expiry that you can find, which happens to be this Friday. So it's going to be fairly accurate. The most accurate is going to be the one that expires today, if it exists. In the old days, we had the monthly. So you might have to wait 3 weeks. So it would have to incorporate some pricing based on ongoing movement beyond the earnings. But this way, it's quite clean. They were expecting expecting $18 and they got what did they get? $80 at one point. I think they got $100 at one point.
$100. It was literally at 199 yesterday, and I can show you a chart. It's ridiculous.
Incredible. Yeah. It's at more than a double since April, much more than a double, I think. So if you didn't think AI was hot, that sector was hot over the last couple of years, we are just kind of blowing away all those sort of narratives. If you look at where we've come from since the bottom of April, which was kind of that AI inference turning point, we kind of went very quickly from okay, they may be spending too much money. Remember Microsoft down to 350, all these stocks started getting clobbered and they said, well, maybe we are kind of running out of sense when it comes to how much money we're going to be spending, CapEx, et cetera. And maybe they're not going to see a reward for that. And then very, very quickly, this started to morph into the inference part, which people have been sort of slow to get on board, which is why I've been very bullish for about 800 points now, is because I kind of saw it a little bit early, because partially I'm reading about it and I'm using it and I'm going, wow, this is going to be a game changer. So from a story standpoint, I don't think anything's particularly weak. For me, if you say this is the end of the story, it's like the printing press. I've said this, it just got invented in 1440. And by 1445, you're going, yeah, I think the printing press has run its course. I don't think there's a whole lot more to go here. So from a story standpoint, we always have to separate story with stocks. So stocks are going to go crazy at times. And as we always say, we've been through a couple of rodeos, Samantha. I've been maybe through a couple more than you, just having been so deeply on the market maker side and having experienced.
Yeah, I only came in September 18th, 2008.
William says, what is a printing press? Well, it's the thing that they use to print endless dollars. But originally, it was Steve Gutenberg's invention in 1440. Yes, Steve Gutenberg was around way back then. He wasn't acting yet, and he invented the printing press. I'm kidding. It was Gutenberg's printing press, and it revolutionized the world. And so I kind of see this phase of AI as kind of having a printing press in your kitchen, in your basement, in your bedroom, in your pocket, which is AI in your pocket and on the edge and everywhere. So I don't think the story is anywhere close to being over, but of course we're going to have exuberance. So when you talk about Oracle, Samantha, I'm like, Oracle, Cisco, what's going on here? I feel like I'm back in the 90s. I feel like Alan Greenspan's going to pop up any minute with his briefcase. He used to walk around with his briefcase and everybody'd be like, wow, look at how he's carrying that briefcase. It seems heavier than normal. That must be, what's he going to say? What's he going to say about the state of affairs? That was kind of the thing back then. We didn't have much for entertainment. So this was our thing, the briefcase. We are so blessed these days with endless entertainment and 10,000 channels and things like that. So look, the market is what it is.
Greenspan, by the way, also had another thing that he carried around, which is an indicator of cardboard boxes and the container business. And basically it's falling hard, as is trucking, recession, and a whole bunch of other tells in the economy, which, by the way, show that there's problems in the real world, just not the make-believe one.
In the real world, we're going to stick our heads in the sand for a little bit until there's the convergence of some sort of reality with what's going on in markets at some point. We don't know when that comes. It's kind of like picking a top based on valuations. It's not very good signal, right? It never really works very well, but it will work when it works, as you like to say. There will be a moment where everybody goes, okay, the narrative is changing. So I think if we start to see a lot weaker employment, that may not be as positive. A 50 may not be as positive. Maybe if we get a good CPI, maybe they go 50 and there's not too much, we're not going to read into that too much because he wants to kind of remove the restrictiveness. But if employment starts to crater a little more, then that's not something the market probably will like right away. I mean, there will be pockets of things that are going to do well. But as we've been saying for a long time, Samantha, that upside has been inexpensive. I got into an argument with somebody this week. What do you mean it's expensive? Well, it has been inexpensive. They're not really pricing in Oracle type moves. And that's really kind of an example of the exuberance that can play into a stock. I was thinking today, even for Google, I was negative on Google, but I started to hedge with upside longer term calls just in case. And I remember at the time I said to some members, I said, these are kind of cheap. Like if I'm wrong, these are going to explode. And sure enough, Google's made a good move, but they were kind of cheap. So the upside is still not very expensive. That's not to say that we are going to go up. I feel that we will, but it doesn't mean that anything in particular is going to happen. But when we start to layer our little bits of edge and insight into everything we do, it's always nice to have cheap upside if you want to play that. That gets me a little more excited about that. But so far, it's the AI melt up, it's rates coming down, its economic numbers are okay. So, I mean, this is an environment where it's hard to really get too bearish at this point for stocks. And I think here we are. I mean, we do have some things. It's kind of interesting to see that it's almost, I don't know if it's just late summer liquidity, but we get these starts and stops. I mean, outside of an Oracle or a Google that are just kind of horse out of the barn a little bit, we are having these nice big moves and then filling right back in again in many names. So we are not quite in the full melt up mode. Corporate buybacks have really tailed off. You've been watching some of those, I'm sure, Samantha. Corporate buyback numbers lower than last year. And they're kind of, we know those systematic types of strategies, the vol targeting, the CTAs and all that. Nobody's really kind of forcing. So if investors are kind of looking for those emotionless types of things like corporate buybacks, like these other things that are buying or selling at certain times, they kind of look for those to kind of start the ball rolling, and then the investors jump on board. If those don't continue or they don't exist, then the investors are kind of waiting and the momentum doesn't get going. So we're at a point where earnings are over. We're waiting for FOMC, and then earnings season is going to be big again. Last season was quite good despite all expectations to the contrary. We're going to see probably some of those problems that you've been mentioning over the last few weeks, that we're going to probably see a little bit of softness from the pull forward earlier and all that. So they're not yet ready to push this market to 7,000. And so we just need that catalyst.
It's hell bent on 6666.
Yes.
Remember that? That was the title of my client post when we did a webinar where it was like, okay, the market's still hell bent on 6666. We're obviously a lot closer to getting there with very little in the way of pause. We had some July 31st end of month shake and bake. We had August 15th through the 20th shake and bake. And then even in last few weeks, we've been talking about Nvidia post earnings. Just did a short on that in the YouTube channel, that it was basically down and then chop and then pop back up for both NASDAQ and Nvidia. And obviously Oracle and PPI were the reason for the season this week, but it was still in the cards as it relates to the option flow. So as it relates to buybacks, just to comment on that, we have 914 is where we have the expectation of that kind of 1.5 billion a day of mechanical support ends. And then Nomura was out today saying 75% of SPX in blackout by October 6th. But the most important is the 75% of the market cap, which is the MAG 10. Avgo is obviously part of that MAG 10. It doesn't go into blackout until October 2nd. So in the meantime, I still see that just what yesterday JP Morgan came out and warned clients, buy the rumor, sell the news of a rate cut into September. So everyone has the same expectation. We're going to kind of be gripped until the FOMC on the next Wednesday, 17th, and then end of the month options expiration on the 19th. That's more typical of when we will get some more chop. In the meantime, in the between time, talking about the real economy and also for PPI, and I got to go over this because exactly, it is the triple of the bottom in March of 2009.
And 666, I think you mentioned this last time, 666 on the SPY, and we had 666 on the SPX back in the global financial crisis.
That's the idea. That's the idea. Okay, so this is what I wanted to show you just to kind of talk about the real economy, because bulls can charge forward, stuff that we've been talking about endlessly for all the reasons I've written about with clients. All gas and no brakes on the fiscal. We've got all cuts and no inflation on the monetary easing. And we've got all buyers, no sellers on the mechanical and retail, etc. So as long as the three legs of a table remain steady, which is the dollar has fallen, and it's good that it's lower because it makes everything appear higher. That falling dollar hugely helped equities. Stable yields. And right now that, remember my zone, my Goldilocks zone is at 4.1 to 4.5. We pierced below it. So we actually broke that 4.1. We're now at 4.03 in the 10-year. And this was a little bit of bonds getting ahead of themselves on recession vibes with the job growth numbers being so high. And by the way, they were expected to come in the high range. They beat 911,000 job revisions versus 818,000 last year. Collectively, in 2 years, we've had 2.3 million, I think, however it ended up, in jobs revised lower, so that job growth didn't happen, and yet we are still ridiculous. We're a double since January of 2023. No, we're higher. Anyway, the point is, it doesn't matter. We don't have a stock market that reflects the real world. So, but as it relates to this PPI, bulls are all excited this morning in expecting that yields are going to fall further, and that's one of the reasons that it pierced below and stayed below that 4.1 area, which was, as as I mentioned, was a target on the short side. If you were looking at fixed income for the steepener, it went into a flattening phase for the 10-year, 2-year, etc. Anyway, but the bears are saying, wait, this is actually pulling forward this recession vibe again because of falling demand. This isn't like back in March, April timeframe where we had falling PPI because of the trade tariff terrors. This is actually, we had that delay and then we had them absorbed into the market. And now this is something else. So they're starting to think about that very carefully. What we do have is a very, very strong job revisions backdrop. And of course, I've written about this a lot. The falling labor market, it's the reason for the season why I study it so closely because it will impact the bond trade. And we're all bond traders as it relates to where interest rates ultimately go and the rate differential with other yields, specifically Japan. So if you ever wanted to see a fractal of incredible tightness, well, I can show it to you in a minute. You take the US Japan 30-year yield ratio and you overlay it to SPX. Mwah. So anyway, the point is we are all bond traders. Anyway, getting into the employment benchmark revisions, they were outsized, largest of all time. You kind of add this up, you get so far, you get a very, very big picture of economic weakness underneath the surface of what's been reported, very similar to what happened in 2007 before the great financial crisis. The one trigger that we have not gotten is jobless claims cycling up and above 267,000. And that's very important. Some Thursday morning, we're going to get and stay above 267,000. We're going to stick that landing. That's going to start to increase. Now, will the market care? To be determined. Last time it happened was 2007, 1 year before the financial crisis started to roll over in October 2008. So this is not a timing tool. This is a warning tool that the market is getting very dangerous at the economic level. Market can still march higher, just like it did, 6, 7 into 8, and then it rolled over fast and furiously for 50% because it creates an air pocket of risk. So right now we're following the generals. The generals are healthy. Okay, maybe Apple's not wowing anybody. It's a thinner design and that's not really going to move the needle. But big picture, it's still the bank of Apple. So the generals are still in play. And until they're taken out and shot, then we really don't have a rollover of size that we can get excited about. And then last but not least, remember that growth ratio that I have been showing you. And this is basically that 2.2. I had mentioned the past few weeks, we just need to bounce. Well, we did. And now we're getting back into what's a 2.3 is the ratio. But it means in my intermarket speak, if we get and stay above that 2.3, we're going to melt up. So we're going to be hitting that 2666 pretty darn soon. We could also get rejected there and have a little mini growth scare again. Maybe it develops into a bigger growth scare if we come back down and break. That turns into a red one if we happen to break and roll over. We're not there yet. Long story short, I wanted to just kind of give you a little bit of a reference on what PPI is bringing forward, what job growth revisions are bringing forward. It's not good news for the economy. And in the meantime, in the in-between time, this is also underneath the surface that you're talking about. This was February 3rd, and this was all green on the scene. Housing, real estate, the labor market, all the surveys were coming out. This is also McGilligan. Green, green, green on the scene. You got tons of bullish backdrop. Now fast forward to September 4th and labor market puking. We got some weakness coming in across the board and they're starting to get a little bit more nervous. So I don't see right now any underneath, last but not least, rant. And I say this to clients every day because I run that live trading room and we're reviewing chase, swing, and trend time frame. I don't see the equity volatility. I don't see the rate volatility. And I don't see the treasury volatility, even with the 4.1% breakdown. So that tells me it's likely going to come back up. Bonds will get pushed back down. They were a little bit too excited here on recession vibes pulled forward. But at some point, we are going to have a growth scare. But it was never going to be in Q2. Q2 earnings were going to crush it. They did not have the impact from tariffs. Now we get to see Q3 and Q4, when the rubber meets the road, how the impact of tariffs on the consumer spending will start to crimp corporate margins. Okay, done.
Yeah. And I mean, look, there have been calls for, almost the beginning of every single year over the last few years for things to kind of slow down and for profits to slow down and for, but people keep pushing forward. And I'm sure part of it is all gas and no brakes, but companies are figuring this out. So you have to be careful. We're not in the buggy whip kind of way of evaluating things. It's maybe a little bit more difficult these days. And I think you are starting to see some benefits from productivity and things like that. And if you guys recall, months ago, I was saying, listen, at some point, inflation is not going to be a problem. problem. It's going to be all about jobs, which it is. I said rates are going to start coming down, which they are. They're getting crushed. I put a huge list in the members area. I said, these are the things you need to be looking at. VCIT, I've got a whole list here. VCLT, QLTA, all these. I said, this is a generational opportunity to grab yield. You may not see these levels for very, very many years because of what could happen in the world in terms of AI being very deflationary and all that sort of stuff. Now, maybe we juice economies a little bit at some point. So that is possible that we have a little bit of a floor to inflation at some point, but it is the return of the 60-40 portfolio, basically. So we're seeing equity rates correlation at 1 year lows. So this is the roaring 20s scenario, part of the roaring 20s scenario that I've been talking about for a long time now, saying, listen, we could get to a point where you are making money on bonds, you are making money on stocks, as long as you're not in areas that have pitfalls and potential disruption, which is going to be easier said than done, because this world of literally thinking of something and creating that app or creating that website or business almost instantly is going to be a very new reality. That's what's maybe underestimated. The downside to that, there's going to be just an awful lot of crap around, a lot of awful innovation, a lot of awful creation, a lot of awful newsletters coming into inundating your inboxes. It's just going to be too easy to
crypto-backed treasury corporate balance sheet stuff. That's the speculative wonder right now of the world, or weapon of mass destruction with all the stablecoin and stablecoin stuff. But that's another. Luckily, we don't address that.
We should have Tom Lee on the show, Samantha.
No, we
I
should
think
not.
we need to.
No,
we
we should not.
Tom Lee with the real Tom Lee to kind of.
We already have your consensus viewpoints because you are absolutely reading the Wall Street mantra, and I'm going to poke holes in that and say, but what about this? What about that? And be careful. Don't be complacent. So now we also have to ask anyone who's here, if you have any questions, you want to dive in on the macro, the sector rotation, or stock specific. And we do need to give some input on the option structure of what we see right now. As I've mentioned, the sector rotation I have been very, very focused on, and we talk about every single time, is this unrelenting, beautiful advance that's turned parabola in the gold, silver, and miner sector. And it has not stopped for all the reasons we've talked about from a macro standpoint I've supported, but also to the fact that the miners are crushing it in earnings. And it's not an AI type of forward earnings bet. It is we're really underinvested. Folks have ignored us. And now we've got it going on. We've got energy prices dropping, which make up 40% of our operating budget. We've got the underlying hot fire flames. So they are crushing it. And people are asking me every single day, when does it end? When does it end? And I'm like, the trend is your friend. It is getting hot. We talked about this GDX target of about 67, 68. We just hit it this week. Again, there's no reason to short all-time highs. The gold sector has really no reason to come back down on a trend basis until we get some balanced budgets. There can be dollar spikes. There can be war armistice will take some of the geopolitical risk out of it. But honestly, there is China still settling trade in gold and silver, and they're not going to stop this move out of dollar and treasuries and the petrodollar, which is oil. They have enough of it of their own, and they're dealing directly with other sources. So anyway, the point is there's a really still strong reason for that to continue. And in the same way, China's doing a lot of stimulus for their consumer base. They have some phenomenal, as you know, I'm a big bull on this oversold rally. As we kind of navigate the top line with the AI bulls, I'm saying, well, what about JD and Baba and Baidu and KWeb and FXI? And they have been phenomenal. Yeah. So those two are still very, very much in play as far as sectors. Are there any sectors that you are in besides the AI wonders of the world?
Well, I like some of the strong secondary themes, the financials. I think nobody sort of figures out efficiency better than, not many areas than finance, especially like the Goldman Sachs of the world, that basically their work is pushing a piece of paper from one side of the desk to another. And when you're in that kind of world of a lot of technology, a lot of platforms, you're really going to be very incentivized to kind of look for those ways to create new cost savings and productivity and things like that. So I think those are very interesting areas, especially in the digital world. So I like the Hoods and the SoFis. I know they're a little bit more on the edge. Something like Hood has been my best trade the whole year. I finally sold some calls. I sort of flipped around did some cover calls as it got above 100. And I remember saying to some members, I said, notice how I did this, because I often get people who buy leaps, or they buy some, we call it the poor man's covered call, where you're kind of buying leaps and you're selling. And they often go, oh, when can we sell calls? Like there's just this absolute urgency to create that income layer. And I say, well, hold your horses. You're getting into something because you want that nice little bit of leverage from the leaps and want to play something that has upside. Don't immediately get in the way. So I waited for 100 and then kind of flipped some calls back and forth. And I just sold some 120s in November now. So I'm going to see what happens. I'm willing to give those some room. Yeah.
Are you still long Reddit? Because I remember when they had earnings a while back, I can't remember if it was June or if it was August, but you liked that a lot. And it's also tied into the AI. They're kind of charging to scrape their data. So are you still in that?
I have very, very little. I have some calls, but very little. I've sold out a bunch. I feel kind of silly about it because I did this big video and I said, this is the real world data and it's not an expensive company. And in a world of everything being kind of fake and created and recycled, that's what's going to happen to sort of this rehashing of things in 45 different ways. Real people and real data and real problems, real conversations are going to be valuable to data sets. And especially there was one decision that came out where I think it was Cloudflare said, we're going to start charging people because it used to be kind of a free for all where you could just kind of scrape data all over the place, which you're saying the scraping. And then they said, no, you're going to have to start paying for this. So I like it. I mean, I prefer it under 200. It's having a great run, all-time highs again today, I believe. And so it's looking good. But other than that,
are you still long Goldman?
Oh, yes. Very big position. One of my biggest positions is in Goldman. But, things are they're getting up. I've got a little bit of Nebius, but not very much at this point. I'm also doing some cover calls on those. I did want to say on the subject of upside being inexpensive, I did notice, and you never name names because we all do silly things, but I noticed somebody before the Nebius, they sold the 58.74 Strangle, which is basically selling, it was 65. Sold the 58 put for 14 cents and they sold the 74 call for 10 cents. And of course, lo and behold, it's a little bit of bad luck, but the thing goes to $100. So, and it was funny because it was, that's I mean,
100% massive loss.
It's absolutely massive, right?
So that's terrible.
In our world, we call that picking up pennies in front of a steamroller. Now, if you had sold a $3 call and a $3 put, I mean, it's going to be better. It's just sometimes there's just a little bit of bad luck, but it's interesting because just a couple of weeks earlier, I had said to some folks, I said, listen, I pointed at another trade and I said, do you guys think this is a good trade? And it was very similar. I'm selling 8-cent calls or something. And they said, no, I don't think so. And I said, you got that right. The thing is, if you do the math on a trade like that, I know it's an outlier. It's a black swan of sorts, but they happen. Now you need that particular income trade to hit 100% win 96 times in a row to pay for that one loss. So just be careful. There's this sort of sense that there's all this free money sitting there and all these way out of the money calls and puts. We cannot predict always. We can't over time, but we can try to not do things like that. So I thought that was kind of
that also could be someone's personality. They just really love those dopamine hits. That's gambling. That's
very
not
much.
Defined. That's gambling. That's not defined risk. I'm sorry. That's not my. That
makes
it is. Been talking
it's
about
excitement for some people. Samantha, it's excitement. I 100% agree.
I like boring but profitable, but that's me. So
exactly.
Everyone has a personality and they manifest that in their options. So that's why I gave you credit for doing the NBIS with leaps. So that's what I was pointing out is you didn't have to be positioned the day or two before. That was lucky if you were. It's not lucky that I've been really, really very, 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 very carefully every single day shaping where ASTS was going to play and JD and BABA, because I'm looking at this as a longer term. You play the swings within the trend. That's all I'm saying is that's definitely not what we want to focus on or the very dangerous trades. Avoid those, defined risk.
Avoid those. Yes. And that in particular, like it's one thing if you own stock and you sell a call way out of the money for basically nothing. Well, at least you're going to get called away. You're still going to make a whole bunch of money because that tiny call, that 5 delta call is going to have a lot of room for you to make money right up to that strike. So you're going to do just fine. If you did it on Oracle, you're not going to be as happy as if you had not sold the call. But look, and that's why one of my rules is I do not do those kinds of trades into earnings because there's plenty of evidence, many studies have been done. And I just know from experience, having run so many of these kinds of funds, that it's overall, you'll remember the ones that worked out and you go, oh, that's fantastic. I feel like I just made a whole bunch of money overnight. There's nothing like getting that rush of making money overnight. But when it goes against you and you give up 10 times that amount, you put that in the past. You become a Tiger Woods where they asked him, what happened that double bogey on last hole? He goes, what double bogey? He just puts it out of his mind.
Next. I have that mindset. It's next to me. It's just next.
You got to just move on. This is a game.
I'm here for the long haul. So it doesn't pay to get too emotional about any particular thing. interesting, but lessons learned are
Yeah.
important. So that's a
I
good one to
still
share.
get tortured. I still get tortured a little bit over time, but that's also caring. I like to tell people, look, I care about every dollar. Now, you can't or you'll go crazy, but you definitely want to kind of think
Yeah,
about
but
everything.
somebody who put that on is not thinking of capital as, no, they're thinking as capital as disposable. So that's,
It's
anyway,
excitement.
more.
It's Vegas.
No, no, it's not.
I'd rather get, well, so yeah, it's not even, look, the odds are
I, I
the
am
odds are extremely high that you're going to keep that 24 cents. Extremely high, but every now and then it won't work out. But for me, I'd rather go to Vegas. At least they're going to give me some mediocre steak, crappy dinner and give me some tickets to Siegfried and Roy. And, I'll have a good time that way with my gambling. Nobody's feeding me here. I'm going to try to do this a little bit smarter.
And remember my motto, good luck. No, we make our own luck. Okay, so
you know what? I saw Siegfried and Roy once, and when that guy, when I can't remember if it was Roy who got bitten by the tiger, I was in the front row and I'm thinking, wow, those tigers were like 10 feet away from me. That could have been a terrible. It makes me nervous that I even went to that show. But anyway,
now
that's
Google
an
writing.
aside.
All right. So getting back to what do you say? Am I always bearish? Absolutely no, not. There is a tactical bullish and there is a macro bearish. So the macro bearish means not being complacent, but looking at both the bull and the bear or lawyering the trade to say, okay, I know why we're going up. It's really simple. More buyers than sellers, but more specifically underneath the surface, what is holding and what is chasing policy intervention, mechanical flows, the promise of fiscal easing, monetary easing, and etc. I mean, oh my goodness, they even tout when the market even starts to thinking about rolling off, they start saying, you know what, we're going to seriously consider removing capital gains tax. So of course, who wants to sell and realize any taxes when there might be a chance that they remove them? The point is, I know the games they play. So I can talk about that. I can talk about the round tripping by Nvidia or the negative double miss by Oracle, but that doesn't matter. I can see both sides of it, but I wouldn't ever short a Ponzi. I wouldn't ever short all-time highs, whether I'm bullish that sector or not. And I keep saying that about gold and silver week after week after week. There's been no reason to get in front of it. If you don't feel comfortable, you got too many profits, well, okay, you can take some off. There's never a bad time to take profits. And Hans is oftentimes working with clients to say, okay, why don't you collar this and protect some of this if you're nervous about it? But the long story short is there's a lot underneath the surface that I do try and project into the future. For example, June, here, I'll show it to you. June of 2024, bingo, this one. I came out on a podcast and I said, as I did in November of 2023, I'm bullish. And then again in all of 2024, I'm bullish. But I also said in June of 2024, quote, recession risk will be pulled forward end of 2025. I made that call in June of 2024 for the end of 2025 because that's a macro thing. Why? It's because employment data is so lagging. Unemployment rate is so lagging. So the trend is falling. So underneath the surface, I can see some of the cracks that are forming that the market doesn't care about. It doesn't price in, but I can see it. And then recession risk gets pulled forward when it starts to become very apparent, like the job revisions number. So I had been already on top of that. That was known. Those job revision numbers, we didn't know exactly what they were going to be, but we knew what they were going to be. Bad. So the point is, I can still be aware. It's called risk aware. It doesn't mean risk averse. And I can make calls about oil falling when literally it was 80. And I said, I see it falling into 60 to 40 range by the end of 2025. I made that call in April of 2024. We were $82 in crude. What did we hit already? 57. The point is, I can see big picture if I zoom out trends in yields and dollar and oil and employment and inflation. Now, I don't agree with this one. For example, this is Gundlach and Bank of America HarkNet. Both can see the risk of 1970s style inflation, another wave coming. I don't see that. So I definitely see stagflationary, in other words, economic slowdown into sticky and rising prices, but I don't see big spikes of inflation coming. So I disagree with this chart. And I also think employment really matters. The K-shaped economy really matters to market returns when margins start to contract. We don't have that. Nobody expected Q2 to disappoint. They had a 4% bar of growth. They beat it at 11% on the aggregate. Nobody expected them to just meet 4%. Tariffs were not in play yet. Consumer spending had not slowed down yet. The unemployment picture, nobody cared about, acknowledged, because the top 10% are doing 50% of the spending. The top top 50% are doing 90% of the tax receipts. Tax receipts are tied to stock market returns, which have been balls to the walls. So anyway, the point is I can still look at the risks coming and fashion that, right? And then still be tactically bullish. And I keep saying there's nothing under the surface. I don't see selling or breadth breakdown. It's Mag 7 concentration risk, and that's unwieldy and that's unsafe. But we're probably 3/4, maybe a year out before the market says, uh-oh, we really do have an employment problem and Fed cuts can't fix this. That's going to hurt margins. And then they start to re-rate equities lower because of it. I want to see it coming.
Right.
Exactly.
You can't have everything. You can't say that this is an economy predicated on 70% consumer and then suddenly destroy the consumer. I mean, I think there's this reality of there's going to be a bigger divide between the rich and the rest than we've ever seen. And what that really means, it's not fully because the consumer is a part of the S&P 500, but there's going to be less of a, I mean, we're already seeing young people, lower income people struggle. It hasn't hurt markets very much because a lot of the spending is done by the people who've owned stocks and assets and comic books and artwork. And this keeps the economy going, right? The wealth effect is a very powerful thing.
Asset holders benefit from inflation, full stop.
Asset holders. And that's what all these people want to do. They couldn't give a crap about the rest of the people, even though it's maybe that's a little bit extreme, but it is about keeping the asset holders flush and spending money, and that's going to work for them. But I think there will be this reality of, I had somebody make a comment today and they said, well, there's a look at the reality. And I said, try not to confuse Main Street with Wall Street too much. Yes, over time, there should be a connection, like implied vol and realized vol. They can't diverge forever. There's going to be a reality to some of that, and that will show itself at some point. You can't just benefit from endless productivity gains and letting go of most of your workers before at some point you go, well, who's going to buy my product? There's got to be some reality set in at some point. So there's also being able to lawyer the trade. Like, for example, you're asking what's up with home builders. You got to tell me your time frame. But for example, I actually follow a really good cycle analyst who, and it's not even this person, but who says the housing market has finally topped and gives a very, very detailed analysis. And I agree with it. Long story short, this is BCA research, and he is basically talking about construction employment. Speaking of home builders, it has fallen. Permits are now starting to roll over, which, by the way, are very, very delayed because of bureaucracy. So the point is, it's not that this divergence is foretelling a housing bust. No, consumers are in such a good place. We have so much home equity value. A lot. Yeah.
And I've written about this. I don't remember the number offhand, but it's in the trillions. And we can unleash a home equity refi wave if we actually get rates below 6%, especially if they're 5.5. Oh my goodness, more liquidity comes into the market. Home builders right now are obviously also these inflationary assets that we have. We do not have a deflation impulse. And there's another real bullish reason that keeps housing prices lifted is we have a massive consumer base of millennials that are just waiting to get into homes, but it's an affordability issue. So it's not that it's just so we're going to roll over. I've never been a foreclosure bro. I was extremely bullish the whole, like all of these years. I have not been bearish on housing, just home builders as a sector rotation. Right now we have a spread differential between the 30-year mortgage rate and the 10-year, which has come back down and helped very, very much for the mortgage rates to come down. And I literally made the call on March 29th. I said, it's time for mortgage rates to come down. And they have. So you can kind of parse out what you want from that. It's a mixed bag. We have a lot of buyers waiting, and it's a huge pool, but it has to be more affordable. Right now, we got also a lot of pockets of the housing that have been held up in this FHA. Anyway, it doesn't matter. The government's been paying for it in the gazillions, which keeps them forbearance basically from declaring bankruptcy. There are so many tools and policies that are keeping the housing market in play, not to mention the mortgage-backed securities that the Fed has on its balance sheet. There are so many levers to keep housing itself, the market, safe because it will impact, obviously, and pull forward recession risk. So I'm not a housing bear. I think home builders have basically, I'm not excited about that as a sector. I don't know what you're talking about for time frame, though. You've got to.
Yeah, I mean, I think that's, you were asking, what else am I doing? Well, this is kind of a theme for me. So I'm always always trying to sort of skate to where the puck is going.
But the mortgage financers, that was
the
an area
mortgage
that I
finance
recommended back
RKT,
in.
which I got that idea from you, Samantha. It's been on my radar for a long time. I was out a little money on it, but I've been adding into strength. So that's one of the things I've been saying lately. Again, I had this question from a member who said, "Oh, why didn't you buy this thing when it was down? You're buying it now when it's going up." And I said, "Well, because I already have a core position. I don't add to losing positions. Not that they're losing, but I don't add to positions going against me if I have a core already in place. If it starts to go in my favor, then that's when I like to jump on the horse that's running. I want the market to be agreeing with me. I don't want to bet against the market. So
Which
I'm
is why
happy to
you
add to good
love the
trades."
AI themes, because everyone is on that train. It's not coming to a stop. Got many miles to go.
Right. It will ebb and flow and we'll have a little of in and out. And I mean, you're sort of seeing like Palantir starting to get up. I mean, it's a stupid expensive stock, but it's a story stock. So I'm looking for these story stocks. There are some other ones which we can talk about next time, but interesting areas where I think people are under appreciating where the AI, for example, I'll give you one, Upwork. So I was kind of negative on that. I told everybody to short it and it went down a ton. And then I said, well, I'm getting kind of interested in it because I'm seeing an interesting change in the texture of how a company like that might benefit. They're going to lose the $20, not Upwork because they're higher end, but let's say Fiverr, they're going to lose the $20 thumbnail people because AI is going to do all that for you. But they're going to gain an incredible amount of business for people who are starting to put some of these tools to use and saying, well, I want to automate this, I want to create this and that. And you can't yet do that. It's not an easy button type of thing, which is why I've been interested in CRM and some of the software names, because I think they've overdone that part of it. But outside of that, yeah, the rocket, I think Zillow is very interesting. I think that unlocking of the real estate market could be very interesting. Now, it's lifting home builders as well. My little theory is that at some point, the home builders may not do as well because you'll unlock that secondary market. And so that's the one that's been frozen for a long time. So I think the interesting place would be, I always like the transactional people. It's a bit almost like my picks and shovels that I always talk about. Zillow's going to make money whether housing is plunging or going up. It doesn't care. I mean, not as much. It's transactional. It's the person, it's the exchange that is merely facilitating things. You're getting information. And so even if AI starts to cause people to have to move from areas and from one state to another or sell an expensive home to downgrade, whatever, these are companies that have the potential, if we see rates continue to come down, to the potential to really benefit from a really nice tailwind. I'm always trying to think of durability. If this happens, it's not going to be a 1 or 2 month thing. It's going to be nice beats again and again and again in certain, not everything, not all the stocks, but certain ones. So I'm always trying to kind of think of those rate sensitive areas. I've been moving into the things that I told you about, some of the very high quality fixed income areas. So my idea is that over the next year, I think the tide lifts all boats because the rates come down and everyone's going to reach for yield everywhere they can. At some point, I think you're going to want to be a little bit more selective. So that's when I'm going to sort of do a switch, maybe a barbell for now, but then a switch to lean more into, say, very high quality. I don't want to see a lot of triple B. I want to see high end quality. I want mag paper. I don't care if it pays me less. I want companies that I am very sure are going to be around that are sitting on more cash than they know what to do with. So I'm going to make that shift at some point to kind of lean into those, but they're all doing well now. And even some of my little dividend plays as well. So those are kind of the areas, those sort of real estate, yield sensitive areas, but also this combination. I've kind of got a thing for a combination of real and digital right now. And Amazon's one, even though it got smoked today. Apple's another one. But I think there are names out there where it's kind of a little bit of real world and a little bit of the broadening. We sort of started to see a bit of broadening. And I looked at my Russell 1000, the one you just showed, basically, Samantha, the 1000 big cap growth versus big cap value. And suddenly big cap growth is in control. So for all the talk of rotation. But remember, rotation in a very strong roaring 20s type market or a melt up is just going to be playing hopscotch. It's not necessarily one pulling back and one doing well. It's one pausing, which is what happens these days. Mag pauses and then the rotation happens. And then the value pauses a little bit or the other stuff pauses, the 493. And then mag takes over again. And Google and all these other ones are making new highs. So
and right now we are still in a growth rotation, which is the whole premise of why I track that stuff, because it just means until the generals actually pull back, there isn't even a chance for volatility, equity volatility. And in the meantime, we still don't even have FX volatility. That might change. Ishida, Japan, Bank of Japan, stepped down on Sunday. Rate hikes might come forward. but they still want a cheaper yen. The companies in Japan also still want a cheaper yen, but not the consumers. Anyway, long story short, we still have no viable rate volatility, even if mortgage rates are falling. And by the way, you ask about a Penny Mac or RITM. Anyway, we have a client who is very, very focused on this space. So we benefit from his very, very deep analysis of these companies. But another one that may or may not have crossed your path, and it is more speculative, but I want to just show it to you since you clearly are, you know, the space. Even though I recommended RKT, which was this back here in this kind of March time frame, and then it did an alley-oop before it actually cleared, and now it's hot fire flames and everybody's on it. There's LDI, and LDI actually, it's a funny, Friday, it hit an alert that I had set. If you can see over here on the weekly, it's been basing for a few years, but it's gone nowhere fast. This is Loan Depot. Well, lo and behold, Citron recommended it as a long because of the same thesis as the rocket. These originators are going to just make buku bucks. So I looked it up, and this was Monday on the 8th. This is my market thoughts for clients. Here it is, Loan Depot. It had triggered an alert. It was up 38%. Citron calls the company the hidden gem of housing finance. Servicing is the floor at $5.50 to $5.75 a share. So basically expecting from $2 to $6 roughly, and it's in this 3.5 area right now. The Loan Depot servicing business is 2.5 times the current stock. This is a quote from Citron, I think Friday after hours. Origination recoveries, the upside, even modest rate moves will spur a refi boom, something I've been talking about for many, many months. And Loan Depot's retention advantage ensures it monetizes that cycle better than most peers. $6 is conservative with its hybrid tech and branch model, ancillary businesses, and high quality servicing book. Loan Depot is mismatched. So that's just an example of how that space Coop, obviously, with Rocket and Redfin. Oops, sorry. They did this. They're now vertically, which was why I got excited about it back in March, and I expected mortgage rates to fall. But LDI is another name. So look for some stuff that's under the radar if you're looking for some kind of surprise.
That's
valuation.
a big thing. That's a big thing. The housing, real estate, all the secondary, tertiary businesses, that's really big. And so to finish my point, I thought the home builders have done well. Why? Because there's a structural shortage. The resale market, the secondary market has been frozen basically because of mortgage rates. And so they've been able to kind of build smaller and give you kind of maybe lesser finishings and kind of appeal to whatever the consumer can spend at the moment. So once that big market kind of unfreezes in theory is when maybe the home builders, I don't know, maybe there's still demand because it's what they do. And they can always, the one advantage is they can always basically figure out what people can afford and what people want and what the tastes are. So they're able to kind of, whereas a resale is just, it is what it is. Okay. If it's a 1972 bungalow, well, that's what you get. So there's still always a business there, but I think things move into that other area, and then that could be Home Depots and all these other nice businesses. So I think that's a positive for, and I think Trump knows that, and he kind of wants the wealth to be spread to other people. Housing is really that massive asset for many people. Like many people have homes
they
that
need
don't
to have jobs. They need to have jobs.
You got to have jobs.
Very,
right.
very important. So right now we have to stay focused on the labor market, which is a very big focus of mine, and a little bit on the inflation, which we're going to get tomorrow. But there's something else tomorrow, and that is St. Louis Fed will do their real GDP preliminary numbers before the BEA comes out on the 25th of September with the GDP final numbers. So that's actually important, speaking of growth. So we'll see if there's any, I'm not expecting any big surprises, but there always could be. So anyway.
And we've got Fed next Wednesday, Samantha. We'll be able to talk a little bit. Yeah, that'll be interesting to see the reaction. Sometimes
but this is different from the Atlanta Fed now, which is nominal, and it's 3.1%, and it's not real GDP that takes into account inflation. So we have to look at more of the real world. You have to look at what's going on with real GDP, and that's been falling. So labor market has been falling, real GDP has been falling, inflation has been sticky, et cetera, et cetera. We still have some potential air pockets of risk with a growth slowdown that the market is not pricing in yet.
I was looking at some sentiment charts the other day with small and medium businesses. That's actually kind of might be a positive because we're still quite negative in that area. So that's where maybe lower rates and AI and maybe some productivity tools, little bits of improvements. There's a lots of maybe, but that's what we do. We've got to kind of look over to the horizon and go, okay, well, sentiment is almost as bad as we've seen it in a long time. Well, is it going to get worse, or do we see some things on the horizon that can actually improve. I very much think that could improve. And that's a massive chunk of employment around the country. This is one thing I wanted to look at here. I thought was kind of interesting. So this is Skew. So S&P index Skew is basically our puts very, very expensive versus calls. So if we say Skew is high, we are referring to the puts. We can get more detailed and say put Skew is high or call Skew is high. That's a bit more specific to the call or the put. But when we say Skew is high, it just means the puts are more expensive than the calls. People have been reaching for those puts. And we can see that we talked about a little bit last week, very, very high, actually, in fact, versus the past few years. So the S&P is very well bid to the downside. And sometimes people see that as bearish. I'm not saying there aren't bears, people putting on bearish positions, but a lot of the time it just kind of means, okay, we want to be long, but we certainly want to have some protection because that makes us feel better and that actually emboldens people to stay long. If you see very, very high skew, the layman might go, oh boy, that's massively bearish. The market's about to get crushed. No, that means people maybe aren't going to be as quick to sell because they're hedged. I mean, not everybody, you can't paint everyone with the same brush, but steep skew is not necessarily a bearish thing at all. But when we look at the Russell is nowhere near the same. Look at the divergence here between the two. And so that's interesting because we talk about this broadening, we talk about how lower rates are really going to help, but this is not yet exhibiting that kind of, hey, let's get long B to the wall and have a protection as well. I mean, you could look at this two ways, right? I'm going to hedge myself a little bit here. You could say, well, there's room for people to get more constructive on the Russell and to get up to this point where they're long small cap, super, super hedge. And then that's kind of a positive. At this point, it's a little murky. So they're a little bit not that convinced, even though we've seen IWM make recent highs over the last few months. And it certainly is acting better. I'd say there's probably a little bit of uncertainty still. And that probably is related to, well, we don't know what rates are going to do. And we don't know exactly what inflation is going to do. And that is a part of the market, a part of the economy that really does need to know what inflation and rates are doing. Whereas big cap couldn't care less what rates are doing. In fact, they like high rates because they're going to make a whole bunch of money on their cash or whatever they're doing. They can issue bonds, things like that. So, but these guys, they need those things. Those are important to them. So they're still uncertain, but I'd like to see this start to close the gap this way. And that would actually get me a little bit more confident to lean into Russell and to lean into small caps a bit.
We will see. So far, they have not broken out. And if they do, then maybe. But in the meantime, in the in-between time. All right. So next week, we've got FOMC. Oh my, we'll be here afterward for sure. I'm expecting 25 basis point cut. I think if they do more, it's more inflationary. It would also give signals that they're worried about recession, which would also make the market unsure. So that's my bet. I'm sticking with it until we get more information, even though the non-farm payrolls revision was even bigger than last year. But I already talked about that. We had a labor cushion last year and we had an election. This time we don't. We don't have the labor cushion and we don't have the election. And even though we have Trump, Basent, Pulte, pummeling Powell, I don't think it's going to happen. I think they're just going to do 25.
The Powell pummel. They're like, it's a cage match. What do you think, Samantha? What if we get 50? Is that a negative for markets?
Yes.
Is that a moment where the markets go,
Yes.
what?
Oh yeah, that's merde. Because it is very much something is wrong. It isn't just, it could be seen as either political, which is fiscal dominance, but I don't think the committee's going to go through with that. Marin is not on the board yet. Lisa Cook will be, despite being fired. So I really think it's going to be 25. I think they do not want to trigger the animal spirits of inflation. They don't have cause for more. Employment is definitely revised much lower, which prompted a bigger cut last time, justifiably so. But I think they're just going to go with 25. They don't want to send any big panic through the market. And I actually think it's going to cause a reversal and yields are going to start to rise again. We'll find out next week. We'll see you on Wednesday. Cheers, everyone.
Okay. See you, everybody.
Bye.
Bye-bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.